Hey, what is going on, traders? This is Mabs. Welcome to another training video. So this video is about the 5-minute scalping strategy that I showed you guys on TikTok. But let's just get into the strategy right now. So basically, you're going to need three moving averages, okay? And then you're going to use the H1 chart and the 5-minute chart. So let's start with the H1 chart, okay? You're going to need to have the 8 moving average, all right? Exponential moving average, which you're going to make green, and then you're going to need the 21 moving average, which you're going to make red, okay? And then if we go down to the 5-minute chart, on the 5-minute chart, we're going to need to add another moving average, okay? We're going to need to have the 13 exponential moving average here, okay? So you're going to need on the 5-minute 8, we're going to need the 13, and then we're going to need the 21, okay? So this is how you find opportunities. You first start on the H1 chart. And then on the H1 chart, you only need the 8 moving average and the 21 moving average, okay? So this is how it works. So on the H1 chart, you're supposed to establish the direction of the market. You're supposed to establish the trend. And then on the 5-minute chart, you're actually looking for entries, okay? So these are the rules to determine whether or not the market is in an uptrend or downtrend, if it's in a bullish market or bearish market, okay? So for a bearish market, the market, the 8 moving average must be underneath the 21 moving average, right? If you go back in time and you look at this area right here, you can see the 8 was beneath the red, okay, which makes it a bearish market. So in a bearish market, you look for sell trades, okay? And then for buy trades, guys, for to get buy trades, you need to see the green moving average, which is the 8 moving average, to be above the 21 moving average. All right. All right, guys. So once we've established the direction of the market, right? Let's have a look at a sell example, and then we're gonna have a look at a buy example. Okay. So let's just say, for instance, we saw on the H1 chart that the green moving average was under the red moving average, right? Which told us that we're in a bearish market, right? And the market now was beneath those moving averages. Okay. We then go down to the 5-minute chart, where we're going to actually find our entries. Let me just put like a horizontal line right here so I can see. Okay, so then on a 5-minute chart, guys, we'd go down to a 5-minute chart to get our entry points. Okay, so this is how it works. So on a 5-minute chart, guys, you want to see the market pulling down underneath the moving averages, okay? And then you want to see it pulling back into the moving averages. But the thing is, it mustn't cross over the red moving average, right? So once it pulls back into the moving averages, what you do is you enter the trade after the pullback. So when the market pulls back and then comes back down, to break the low, that's actually where you enter the trade right there. So when you enter the trade, you put your stop loss either above where the pullback was, or you put it where the red moving average is, and then you just model a 1:1 risk ratio. Let me run it back one more time, okay? So this is what you need to see. You need to see the market pulling down, and then you need to see the market pulling back into the moving averages, okay? But it mustn't go above or close above the red moving average. It can wick above it, but it cannot close above it, okay? And then once now the market has pulled back, you come and you enter when the market breaks the low of the pullback, okay, where the pullback began. And then once it breaks that low, that's where you enter the trade. And then once you enter the trade over there, you put your stop loss either above the moving average, okay? I mean, either you put it above where the pullback ended, or you put it where the red moving average is, and then you can just model a 1:1 risk ratio based off of the distance from the entry point to the stop loss, and then you can just risk 50 pips for 50 pips or 10 pips for 10 pips type of situation, okay? Here's another example down here. Let me just delete some of these lines over here. Okay, so as you can see, guys, you saw in this example here, the market continued to go down, and then it pulled back. It pulled back into the moving averages. Okay, so the market mustn't close above the red moving averages, but it must close beneath that in the pullback. And then your entry point is actually when the market pushes down, right? And then it breaks the low of the pullback right there. So if it breaks the low of the pullback, that's where you enter your trade. You put your stop loss either above the pullback, or you put it where the red moving average is, and then you model a 1:1 risk ratio right there. Okay, now let's have a look at an instance where we were supposed